Hey guys, Boris. Welcome to the Commodity Dollar Technical Review for SEP 12 to SEP 16 for Aussie dollar, dollar CAD, and Kiwi dollar. So I think the most interesting and ironic aspect of this week, of course, is that the high yielders got pummeled, especially, and this is the interesting thing, on Friday as I'm recording this, it's the end of the week. And ironically enough, not because of anything terrible within the economies of each one of these countries. Simply, here's the thing. It's a dollar rally. And ironically enough, the dollar rally is hurting the high yielders the most, mainly because of the yield differentials. Remember, a huge amount of money flowed into the Aussie and into the Kiwi based upon the fact that their yield was going to stay high and the US yield was going to stay low. So the carry traders really tried to optimize their cash flow by putting money into Aussie and the Kiwi. Now, over the last 24 hours, we've had a huge amount of speculation that the U.S. yield curve is starting to go up, and it's really now become sort of what's called a 2 and 2, where you're looking at the 2-year U.S. against 2-year odd rates as the key tell of where that spread is going. And as that spread compresses, it doesn't have to be absolutely large or absolutely small. It's not the absolute value of that spread that matters. It's actually the relative value. As that spread compresses, it's causing a huge amount of profit taking to flow out of the Aussie, especially, and the Kiwi as well. So you had this, ironically enough, the collapse of the com dollars as the end of the week came in, really are nothing more than just a sort of profit taking. Now next week, the calendar actually is sort of showcases the calm dollar story. I mean, we closed the week here with relatively decent Canadian labor data, but dollar CAD can't get out of its own way. It's sort of in a different story set than the Aussie and the Kiwi. But as far as Aussie goes, we have the employment data coming up next week, which is going to be seminal. That's really very, very key. Kathy probably has written about this, but I just sort of want to give you a heads up if you haven't read it, that I think we were looking at all of the odd PMI data ahead of time, and there's no doubt in our minds that it's going to be very challenging for the Australian labor data to come in as strong as the market thinks. Of course it can, but generally all the PMI data is signaling a pretty significant slowdown across all the sectors, manufacturing, construction, and services. And generally when we get that kind of a triple move to the other side, there is a strong chance that this number is going to miss, which means Aussie could be under further pressure as the week continues. Kiwi has the GDP numbers, and in many ways, the GDP is actually expected to rebound. And I was going to say that probably in many ways, we're going to look at the cross ideas, of course, later on in our section. The odd Kiwi trade is probably going to be one of the more interesting trades next week, simply because you have this potential of divergence of economic data that could then, of course, lead to a divergence of monetary policy. So that's in some ways going to be one of the more interesting crosses to look at, given this is the central story set of the week. Now let's take a look at just the general levels for the majors, for the com dollar majors, and just see where things stand. So odd had a nice big move, and then it kind of came off that move. Big move to the downside. Support now, even though we're very close to it, really rests pretty strongly at the 7,500 level. 7,450 is sort of the ultimate support of this big move. Dollar CAD still in this 131, 128 range, no matter how hard it tries. And what was interesting about the CAD story is we had great labor data today. We had 4% gains in oil yesterday, and despite all those things, the Canadian dollar cannot get up off the mat. The loonie is greatly compressed to the downside, and the reason why is, again, has to do with yield differentials. It's the fact that U.S. yields are popping up, and as U.S. yields pop up, it doesn't matter what the other story is. The money flows to the dollar and out of the loonie. The one that's sort of holding up the best is, of course, the Kiwi, because Kiwi has the highest yield and therefore the biggest attraction, and also has the least possibility of the RBNZ doing anything more than what they've already communicated, which is perhaps another 25 bips of cutting before the end of the year. So Kiwi's kind of holding tight at a relatively high level. We broke out to fresh highs this week, so that's very much worthwhile noting. Let's take a look at the charts here, and we'll start with the Aussie. Sorry, let me just get rid of my lines, and we'll start with the Aussie and just go on from there as far as the trades go. So it's a really big flip. I mean, this is technically this looks much uglier than just profit taking, but really fundamentally this is nothing more than profit taking. And again, take a look at the big picture. When you're looking at the bigger picture, you still have undeniable uptrend, series of higher lows that has not been violated yet. It really doesn't get violated to 74.50, another 100 points to the downside. Is it possible we just continue, flipping? Yes. If Labor Day, if we can't get any kind of juice and Labor Day fails, we're probably going to test the 74.50 support. That's going to be very, very key. Did we fail modestly in front of the 77.50 highs? We did. Is that a kind of a terminal fail? No, but this was generally, when you have this kind of a turn in the Aussie, that's a pretty ugly move to the downside, and it really needs significantly better economic data to kind of turn this around. So if we have poor data, I think the downside here has potential all the way down to 74.50. Only a combination of two things, sort of strong Australian data and a complete walk back by Fed officials next week. U.S. rates collapsing back. In many ways, this is really the most important thing is ignore everything else, look at U.S. rates. If U.S. rates don't collapse, very hard for the Aussie to come back from this shellacking that it took this week. But for now, of course, 77.50 is the big upside trade. That's unlikely for us to take out. Next week, it's going to be much more to the downside. The downside support comes in at 74.50. That's really where you want to be. If you're looking for bargain hunting, that's really where you're going to be parking your bids. But for now, there's still another 100 points here to go, and the Aussie could certainly squeeze to the downside over there. Now, dollar CAD, what was interesting here, as I said, higher oil prices, none of these things helped. We came down, and ever since you guys have been listening to me, I've been saying nothing more than just buy the dips in dollar caddy. That's been a great trade, and it continues to be a great trade. Buying in front of the 28s worked like a charm again last week, and we're going to continue doing that until it stops working. So for now, you sort of, any kind of a retrace down. As a matter of fact, I would say just any sort of mild retrace. If you can get position underneath the 3000, you'd be in good shape here to probably position yourself for a move back up to the 31s. And if U.S. yields really firm up, really a potential all the way up to the 32s, which is the upper end of this range. But caddy, as I've been saying, is a range trade that's in a stealth bull market because it's so subtle that there's an upward trend here. You almost miss it, but it is nevertheless a range with an upward bias, and so you just have to buy the dips in this thing until it basically stops working. And then last but not least, let's take a look at the Kiwi here. Sorry. And what's interesting about Kiwi is that, yes, we broke to fresh highs and then just dipped right back down. So here now comes, and Kiwi is in a very, very clear, strong, nice channel uptrend, but it's testing the lower end of its uptrend. I mean, if we break down, I would say if we start coming down to 72.50, that's an incredibly ugly technical formation for the Kiwi. And at that point, it doesn't matter what you think. You really have to basically sell every rally. You have to assume, if we come down all the way down to 72.50, every rally should be sold because you have to assume the 75 is the near-term peak, is the near-term top. As a matter of fact, let's go back. Let's just go out on let's go three-year base. I just want to see. This is the 75 was from 2015. That we haven't touched that level since 2015. So it's natural that we failed, and it's quite possible that we could fail all the way down to 72s on this move as we correct. So although Kiwi looked like a relative strength trade, I would be very cautious trading this. You certainly could buy right now. You certainly could buy it, but if we get down to the 7200s, I'd bail out of the trade. I really would. The 7200 is the near-term support here, and a break of that pretty much violates all of this uptrend that we've had in place for quite a long time. So it should be interesting. Basically, it's sort of interesting because if you sort of make an anti-dollar bet, right? If you say, you know what, all this hoopla about U.S. yields and everything else is going to be yet another fake out. If that is indeed a fake out, you definitely want to park yourself as a buyer here, 73 to 72 down. But you need to be very much aware that if it kind of slices all the way down to below 72s, the technical formation is broken, and you do not want to be holding this bag at that point. So that's kind of how the week shapes up for the calm dollars. 74.50, very, very key support for the Aussie. 72 is the very key support for the Kiwi. And with dollar CAD, it's just basically 28 is the support there, and 31, 32 move to the upside as Canadian dollar continues to be relatively weak to everything else. Wish you guys the best of luck, the best of trading. Boris Over and out.